Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 29th of June 2020 and we're talking about gold and the US banking system stress test concerns. Now we've come across two interesting articles published today by two bullion dealers, Bullion by Post and Bullion Vault. The first is on Fed concerns about US bank stress tests, and the second is highlighting how demand for gold and certainly paper contracts are increasing, especially as COVID-19 concerns also increase. So let's look at each of these in succession, and then we can give a brief comment. Bullion by Post article dated 29th of June 2020. Headline: Fed warns of catastrophic impact of second wave on US banks. The United States Federal Reserve Board has published the results of its supervisory-run Dodd-Frank Act stress test for the United States' largest banks. As a result, a number of restrictions have been placed on US banks to try and ensure they have the capital to survive the current financial crisis. The stress test is a simulation designed to determine the ability of 34 US banks, each with more than $100 billion in total consolidated assets, to deal with an economic crisis. Today, COVID-19 is that financial crisis. Goldman Sachs Group and Morgan Stanley were hit the worst under the hypothetical adverse scenario. They warned that loan losses could reach $700 billion across the 34 banks, and that while some had strong capital to protect them against such losses, several banks will be at risk of hitting minimum capital levels. Of note, the stress test did not incorporate any anticipation of further stimulus measures or government spending. It also worked primarily on the idea of a V-shaped recovery, which would see the economy bounce back from recession fairly quickly to pre-COVID levels, a recovery considered by many to be unlikely. The US has recorded 2.4 million confirmed coronavirus infections and 122,370 deaths, though experts have warned that poor testing numbers means this is likely much higher in truth. There are worrying signs that numbers are only growing in America, with a number of states recording record numbers of cases and reimposing restrictions just a few weeks after opening. States like Texas have seen daily cases rising to 5,000 a day, and attempts to impose restrictions have resulted in protests, as seen in the image above, which you can see at the top of the screen, with efforts to bring numbers down failing. There will likely be further economic damage for the United States throughout 2020. Should this continue, there are obvious concerns about the strength of America's banking institutions and its ability to deal with the situation. The failure of the banking world in the 2008 crisis is far from forgotten. Indeed, the stress test and bank regulations were introduced in 2010 as a result of the 2008 crisis. This was after Lehman Brothers went under at the start of the subprime collateralized debt obligation losses that led to the 2008 Wall Street crash. Complex subprime loans made to high-risk house buyers, which totaled $640 billion, are now a thing of the past in the banking industry. However, similarly complex collateralized loan obligations to high-risk businesses continue today in financial services. No concrete figures are available from financial institutions, but in 2008 the Bank for International Settlements estimated these high-risk loans could total $750 billion. In view of the huge economic disruption of coronavirus to investment banking, the Fed is now imposing several restrictions, while also requiring the largest US banks to resubmit updated plans on their finances. A statement from the FRB said, quote, "All our large banks will be required to resubmit and update their capital plans later this year to reflect current stresses, which will help firms reassess their capital needs and maintain strong capital planning practices during the period of uncertainty," unquote. Now, the Federal Reserve is also requiring these big commercial banks to limit shareholder dividends while suspending share repurchase schemes. With a stress test release, Federal Reserve Governor Lael Brainard said This is a time for large banks to preserve capital so they can be a source of strength in a robust recovery. She went on, I do not support giving the green light for large banks to deplete capital, which raises the risk. They will need to tighten credit or rebuild capital during the recovery. Fed Vice Chairman for Supervision Randall Quarles added, if the circumstances warrant, we will not hesitate to take additional policy action to support the US economy and banking system. After the failure of the banks in 2008, the efforts of the Fed to keep these financial institutions strong is certainly welcome. Given the limited scope of the stress tests, however, many will question just how robust the results and subsequent required actions really are. Having gained almost $100 per ounce in just under a month, many investors clearly share the same concerns over how strong the fiat system truly is, especially in light of the continued money printing being done by central banks globally and rising numbers of cases globally. With fiat money at risk, many are turning instead to physical bullion to protect their wealth. Bullion Vault article dated Monday, the 29th of June 2020. Headline: Gold prices steady as stocks cut rally. Money supply soars. COVID claims 500,000 lives. Gold prices held steady Monday lunchtime in London as Western stock markets gave back an earlier rally after the number of confirmed cases of COVID-19 passing 10 million worldwide, with deaths topping 500,000. Writes Atsuko Whitehouse at Bullion Vault. Gold-backed ETF investment funds grew for the 14th week in a row last week, while speculative betting on gold prices rising through the US market of COMEX futures and options expanded to its largest in 8 weeks. Spot gold prices today held flat at $1,770 per ounce, while the dollar index, a measure of the US currency's value versus its major peers, slipped after 3 consecutive daily advances. Silver dipped 0.1% to $17.80 per ounce, while platinum edged up 0.6% to $816. US Treasury bond prices were unchanged, holding yields flat as the United States passed 2.5 million confirmed infections and more than 125,000 deaths from the global pandemic, according to data compiled by Johns Hopkins University, with a spike of 45,255 on Friday alone. Gold is benefiting from the growing concern that the COVID-19 has been badly underestimated, said Gavin Vent, analyst at Australian Tipsheet Mine Life. Gold is also benefiting from the trillions of dollars of stimulus that is being fed into the economy by central banks and the likelihood of negative real interest rates in the United States. It's a double whammy that's enormously supportive for gold prices that will likely push them to record highs. The US monetary base agrees ICBC, Standard Bank's former Tokyo manager Bruce Ikemitsu, now chief director of the newly established Japan Bullion Market Association, has ballooned, the US monetary base has ballooned to $5.15 trillion with the current quantitative easing. The correlation between the monetary base and gold is extremely high at 0.909. As long as this money expansion continues, gold will rise, perhaps with a view to $3,000. Latest data show that hedge funds and other leveraged speculators in COMEX gold futures and options increased their bullish betting and cut their bearish betting on gold as a group in the week ending the 23rd of June. Overall, that pushed the net long position of managed money traders to a 2-month high, notionally equivalent to 546 tons of bullion and larger by almost 50% from the past 10 years average. Including producers, refiners, bullion banks and other participants, the total number of COMEX gold future and option contracts open across the market meantime rose back above 1 million, a fresh all-time record when reached in mid-2019, but a level not seen for 5 weeks. Gold-backed ETF trust funds also continued to expand last week, with both the SPDR Gold Trust and the iShares Gold ETF seeing net inflows. The GLD grew 0.3% on Friday to reach its largest size in terms of shares in issue in more than 7 years, while the cheaper IAU product also expanded by 0.3% to set a new record size. Monday found gold prices for European investors down 0.6% to €1,567 per ounce as European stocks advanced ahead of German Chancellor Angela Merkel and French President Emmanuel Macron meeting later in the day to discuss the European Union's proposed €750 billion recovery fund, which is equivalent to $842 billion. UK gold prices in pounds per ounce edged higher by 0.1% to £1,437 per ounce as sterling weakened on the currency market amid Prime Minister Boris Johnson's promising a wave of infrastructure and skills investment, while the first in-person Brexit talks with the EU since March got underway in Brussels. Now, our apologies that the articles are a few minutes long each, but they certainly point out that gold is going to be a safe haven asset class moving forward and that investors are becoming increasingly nervous, including the Federal Reserve. Yes, equity markets today have been a little excited at the prospect of even more stimulus, but this may be short-lived. Economic data may point to an improving economic situation over this past month, but if the COVID-19 cases rise even further, then even this could be to no avail. Gold and silver have moved slightly since these reports were published, with gold currently standing at $1,773 and silver at $17.87. Now, with considerable economic news to be announced later in the week, we have little doubt that we shall see some price movements or oscillations before the US holiday on Friday. Meanwhile, what do you think? Do you believe that gold is likely to rise later this week? Or can you actually see it being capped a little? Is it definitely the solution to one's economic woes with the level of money printing? And how long do you really believe that it will take before we shall see this rapid rise in gold price that so many speculate could be well above $2,000? Do share your thoughts. Meanwhile, thank you so much for listening, and if you haven't already done so, do subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.